Can you see the screen and hear my voice? Awesome. Awesome. How you doing, Charles? Robert? Patty, good to see you as always. Lou, Jack, nice to see you. Nice to see you. All right, we have a special guest presenter. I don't know if you got the email. It kind of went out last minute. Steve forgot to give Lauren the text, I guess, but hopefully you got it. Anyhow, tonight we have Doug, the king of swing, as he's known. He's going to do a really, this is first of two parts of a well thought out and well detailed presentation on swing trading. Okay, how to apply Steve's method to swing trading. And I don't want to steal his thunder. He's going to give you all the pros and cons. But let me just read the disclaimer here real quick, and then I'll turn it over to him. Nothing presented in this webinar or video presentation, either vocally or visually, is to be taken as trading advice. All content of this presentation is for educational purposes only. Any trades you take should be your own decision. Don't trade with money you cannot afford to lose. So now we got the legal out of the way. Yeah, exactly. Use only your kids' college fund. Let me turn it over to Doug. Doug, you there? I'm going to make you the presenter.
I am. Thank you very much.
Okay. All right, you should have control.
All right, and hopefully everybody can see my screen and hear my voice. Okay, I'm seeing some Y's getting thrown up. And just one bit of info. I'm not going to be looking at the questions while I'm doing this. I'm going to be taking the questions at the end because there's a lot of stuff that I do need to get through. Even though this is being split up into two parts, I need all the time I can to get through this main material in the beginning before we even start looking at charts. So please, save all your questions, write them down, and also get out a piece of paper. You are going to need it briefly. So without further ado, let me just get into it. Most people, if you've seen my homework presentation, you know a little bit about me, a little bit of the story, the backstory. Been with Steve for quite a while. Did horribly for most of that time until I started actually doing the homework, and I buckled down. And what led me into this was when I signed back up to the DMR back when the email blast for Ted and his account back in towards the tail end of 2014. I think it was October 2014. I signed back up and didn't really do much again. And a couple months later, I noticed that Marta, an old friend of mine from back in the OTA days, the original group, I saw that she was running one of the DMR groups, so I asked her if I could join up. And I still wasn't seeing any success. I wasn't really doing the homework as much. And I realized, I said, maybe I just can't focus on the 15-minute. I've been up and down trying the 15-minute, the 5-minute, the 1-minute. I've been all over the place, 30-minute, different EMAs. The only thing I never did was left Steve's system. So I knew that she was involved in some swing trading. I heard that she had seen prior success, and she said, yeah, at one point she did, but she kind of got away from it because things weren't working out. And I suggested to her, hey, what if we do a study group? A real study group where we get to and we go over charts and we do homework on the charts. And she said, yeah, she asked if I'd like to head it, and I did, and we got some like-minded individuals from our parent group, the Safety Hunters, and we got together and we started going over charts. And now what we did is we didn't just get together and go over charts. We had little assignments. We were going to do 6 months of the 4-hour every week, and we'll go over it, and we'll share our screens together with TeamViewer. And it started going really well. And before I knew it, it eventually kind of turned into me just talking about the 4-hour charts and the 1 hour and all the stuff that I was seeing. And we'd pass it back and forth. But, what you're going to see here, what I'm going to be talking about is a culmination of a lot of those meetings and a lot of my extensive homework. I've backprinted charts with all the Gartleys for 5 years on all the major pairs. I do Gartley work. I do psych level work. I put the psych levels on 5 years of my charts and go over looking at the 4-hour with nothing but psych levels to see where they pin. All sorts of crazy stuff. So we're going to be covering the foundation fundamentals, and then we'll get into some chart examples. And next week we're going to be doing a lot of examples in depth with trade management and stuff like that. So now that you know where I'm coming from, what we're going to be doing, let's get started. Okay. So this is swing trading in Btmm style. That's it. Okay. This is utilizing the foundational knowledge that we have of the method and applying it to holding the trades. Okay? Here's what we're going to be covering from top to bottom, or I guess from peak to peak, a basic overview of the fundamental concept at the core of the Btmm, okay? Because most people kind of think they understand it. They go through the 4-day course, they go through a bunch of the boot camps, maybe some of them, and then they just kind of get into the buzzwords and the patterns, the smaller patterns, and they kind of gloss over the deeper understanding that Steve constantly tries to reinforce. So we're going to be covering that. We're going to talk a little bit about the two styles of swing and why you only want to focus on one, especially beginning. Okay? The different cycles of the market, the different phases, and how they're going to affect your approach. Of course, the setups and entries, management, TPs, bailing and scaling, when to get out, when to get in more, as well as, stops. We're going to kind of lightly touch on it. Obviously, psychology. You need to have a firm grasp of, what's going on inside your head and psychologically inside the market to be able to, really successfully swing trade, to stick with your position. And, of course, developing your vision. In case you guys didn't know, I'm pretty big on the homework now. So we're going to be doing homework. We're going to be focusing on what to be looking for in the chart and the importance of homework. And you need to do that in order to develop your vision and be confident and comfortable with the stuff that I'm going to show you. Okay, what I will not be covering, M15 entries, okay, anything M5 or M1. And, of course, not really going to be covering risk management. All that stuff has been covered to death and by much more qualified people than me. I'm not an M5 or M1 guy. You want to, scale down. All this stuff can be scaled down into the M15, the M5, the M1, obviously to tighten up your entries. I'm just not that guy. There's no way I could possibly speak on that stuff when you have monsters like Ted, Amir, and Paul dealing with the M1, and you got Carr, Joe, and Jim magnificently covering the M15. The stuff that's the core, okay? So I don't really need to dive into that. That's the kind of stuff you guys have been studying relentlessly your entire Btmm career. You don't need me to say anything more on it. Okay, so the core concepts, and this covers me. I say the one thing you need to know and understand in one sentence, but it covers a couple of core concepts that you need to have internalized for your swinging, for all the trading in general. But if you're going to be planning on holding something that may take 3 days to produce or 2 days to actually produce, you need to fall back emotionally on, okay, I understand what they're doing in the market. Okay, so we're doing this in the form of a quiz. I'm kind of excited. This is my first quiz, everyone. So I just told you earlier, get out a piece of paper. Hopefully you have a piece of paper, you have a notepad open. Maybe you're doing it on your computer, but I want you to actually write this stuff down because it's important. All right? So I want you to ask yourself, have you internalized? What is the business all about? Have you internalized that? So what is the answer to that? And you don't need to type it inside the chat. I mean, you can if you want, but I'm not looking at that. Number 2, what is the primary objective of the market maker? Okay? You're sitting down at a bar with a friend, at the table, the dinner table with your family, your spouse, your partner, whatever. You're talking to a coworker. In one sentence, boil it down. What is the primary objective of the market maker? How many days is the Mona Lisa picture perfect cycle? That benchmark? What does it actually mean to hit the stops? Silly question, Doug, right? Well, in working with Carr's study group, I do a lot of one-on-ones with people. People that take mistaken trades, or they want to ask about the homework, but they don't want to ask in the study group. I'll do some one-on-ones, and it turns out a lot of people don't actually understand what's going on. So that's why I'm asking here. Now, number 5. Does the market have to do anything? Okay. Now you can keep these short. What does it mean to hit the stops? Maybe a little bit long, but we need to move on. If you're not done writing, I do apologize. Okay, number one, the money. That's it, full stop. That's what it's all about. And we're constantly going to be coming back to that. Number two, what is the primary objective of the market makers? This is directly from Steve. He says this over and over in his boot camps and his main course. It's to create a sentiment and act against it. That's the boiled down version. Of course, the main course takes 4 days to cover all the nuances, but boiled down, one sentence, that's their primary objective. Yes, it's to get your money. It's to get you to commit your money, to click in. But they do that by creating a sentiment and acting against. What's that thing that Jim, the phrase that Jim likes to say? Induce, trap, shift, repeat. Creating a sentiment and they're acting against it. So internalize that. Know that with everything that you look at, this is what's going on. So how many days are in the Mona Lisa picture perfect cycle? 2.5 to 3, up to 5. Now we're going to see in the larger structures, we're going to see larger structures that take 2 weeks, 3 weeks, even up to a month. But I'm asking about the basic Mona Lisa benchmark market maker cycle here. What does it mean to hit the stops? Well, yeah, it means to take out the stop loss of those that got it right, but it also means to trigger the sell and buy stops. I know there's a lot of people that are new to the market. They never traded anything else. They came into Forex. Some people never deal with pendings, but there's two kinds of pendings. There's stop orders and there's limit orders. The stop orders are the orders that people place as breakouts, okay? You got a range, something's about to break out. You think if it breaks past here by 20 pips, it's going to keep going. So you put in a long position, for example, you put a buy stop up above the range, all right? If the range is going, you think it breaks out below that range. If it breaks out below by 20 pips, it's going to keep going, so you put a sell stop below the range. So when we say they hit the stops, and I've asked a lot of people, what does this mean? And they always say, oh, well, they hit the stop losses. It's not just the stop losses, okay? Now, sometimes it gets said like, oh, they hit the stops, pick up the pendings. Well, that's what, when we just say hit the stops drop, hit the stops rise, that's what we're talking about. They're hitting the stops anyone that got it right, picking up the orders, stopping them out before they even move, and then continuing. That's what you have to internalize. And does the market have to do anything? That is an unequivocal no. It doesn't have to go up 2 days or 3 days or 5 days. It doesn't have to go past level 2. And we're going to see in a lot of the structures, they're micro structures and what I'm not talking, well, they're macro structures to the 15-minute, but in relation to the 4-hour, which is going to be our primary thing, a lot of times stuff only goes up 2 levels as far as ADR, that the 50 barely crosses the 200, and then you get the middle of a larger structure. We're going to be talking about it. We'll see it. Okay? Last 5 questions, then we're going to move on. How do the MMs handle the levels? And these answers are a bit more involved, so you don't have to write these down. Just kind of verbalize them, think about them. What is the market maker's participation in each of the levels, as discussed by Steve? How do the market makers handle the peaks? What is their primary, what are they doing at level 3 during the peaks? What are the MM's primary weapon against you? Okay, have you internalized what their primary weapon against you is? Most of you haven't, and this is one of the biggest problems. 4, have you internalized what your main advantage is over the dealer? What is your one advantage over the dealer? 5, what are you supposed to do if you're unsure of the level or direction? Okay. Number 1, L1 and L3, the market makers are active and inducing, and in level 2 they step aside. Now, completely absent? No. The market makers make the market. They are liquidity providers. They are involved in every aspect of the market, every phase, every level, every little push. They have to. The difference is L1 and L3, they are inducing. They are creating that sentiment. They are actively driving the price in order to get people to buy or sell, to commit their money. L2, they still have to absorb all the orders, take the orders, do the buying and selling, but they're not heavy with their activity in driving the market during L2, okay? Now, how do they handle the peaks? It's a big answer. They're in heavy, they're widening the range, they're inducing, they're trapping, and their net position becomes opposite of the prevailing the retail trader's trend. Okay, they're in level 3, they're driving it up. Let's say a long, they're driving it up, they're buying, they're inducing long, they're creating more excitement. Once the volume starts building up, the market, the retail traders start buying in, they start laying off the buying, the market makers lay off the buying, they're selling into all these traders that are trying to go long. They're selling. Then they start selling even heavier. They drop off that first leg, and that's when they start creating the chop. It pulls back off. They start buying heavy again with the added momentum of the retail traders to start pushing up. They don't have to commit that much more money to create that second leg. And this entire time, everybody's buying. What are they doing? They're absorbing the contracts. They're selling to these people, so they're accumulating their shorts. And then finally, when their books are shored up and they got what they need, they start selling heavy and dropping the market. You should be able to verbalize that. That's why the title of this is, have you internalized this? Can you sit there and explain that to your friend, to your partner? Or do you just go, oh, it's level 3 because I counted some boxes? Or are you looking at the behavior? That's what you need to do. Okay? 3, what is the market maker's primary weapon against you? That's time. As I see it, and in regards to swing trading specifically, that's time. Steve talks about this all the time. Yeah. They can hold a level all week or a month. They can do whatever they want. I remember a couple years ago, I was reading some Forex Factory, which, don't worry about it. That's my reality television. I like to read Forex Factory, Forex, Peace Army, Baby Pips. So it was a couple of years ago, and all the pairs had gone into like this 15, 20 pip range. And at one point, I come across this post by some dude that goes, won't they just move? I just want to buy already. He didn't even care he just wanted to buy. That's it. He had this bias and said he just wanted to buy. He just wanted to see some movements. So they were holding for weeks on end in 12, 15, 20 pip ranges, and that's what they do. So that's their primary weapon against you is time. And you all know that from the way they hold stuff. Oh, my God, won't they just move? Okay? Now, what main advantage do you have over the dealer? You can stand aside and wait. That's your biggest advantage. That's the number one weapon you have. You have this fantastic method. You have all these patterns and stuff that you can see. You know the underlying premise of the market, what's going on behind the scenes. You can stand aside and wait. But do you? Okay, you're going to have to if you're going to want to swing. All right. Now, number 5, what are you supposed to do if you're unsure of the level or direction? What is the one cool trick? Nothing. You stand aside. One of my favorite quotes is, cash is a position. Okay? Now, that's the end of the quiz, but it's titled this for a reason. Have you really internalized all this? I submit that there's a lot of people that haven't. They know the answers, but they haven't really internalized it, and it's important that you get this stuff internalized as much as possible, and it just becomes a part of, like, yeah, this is just how it is, and you accept it. That's when the calmness comes, okay? Because if you know this stuff, but you don't really internalize it and accept it, you fight against it, and it causes all the problems that we experience, and believe me, I know. Okay, so the swing trade, what it is and what we're looking for. I'm going to cover the 2 styles of swing, all right? Mainly, for our purposes, I'm separating swings into 2 categories, swing trading. We got swing, and we have the carry trade, okay? For the purposes of the definition, the swing is 2 to 3 days, 5 days, and potentially up to 2 weeks. There should be an asterisk there with a bit of a caveat. We'll get to that. Okay? Oh, okay, there's a little error in the slide there. All right, specific targets based on technical and well-defined price point targets, okay? Take profit and where we want to get in, all right? This seems kind of obvious, but in talking with people and reading various things about, people that do carry trades and my experience in getting to this point that I'm at, there's a significant difference between the way they're handled, okay? We want specific targets based on technical and well-defined price point targets, and we're going to be discussing that. The carry trade, on the other hand, is typically greater than 2 weeks, upwards of a month or more. That's when you have a big line to swing, and you're wanting to load up with 100, 200 lots because, well, I think the New Zealand's oversold right now, or it's the New Zealand is overvalued and compared to the pound. So I think the pound New Zealand should actually rise quite extensively, and it's just not the market isn't representing the true value. So I'm going to hold it up to this. I think the New Zealand's only really worth this against the pound. Okay, that's typically what you'll do, and they're general targets based on fundamentals more than anything. And I don't deal with fundamentals. I know some very basics, but that's not what I'm interested in, okay? And a lot of times I see a lot of people talking about like, oh, well, it could go down here. Look at the low from last year. Look at well, how long is it going to take you to get there, and what are your opportunity costs? So my vote is don't bother on the carry. Focus on your swing. Start off 2 to 3 days, okay? Real quick, the pros and the cons of a swing trade. Again, not talking about carry, swing trade. The first two are asterisks. We're talking strictly versus M15. Nice big moves, obviously. There's more potential of a profit because you're less micromanaging. We know we can grab 50 pips or 30 pips and okay, we got MAAW, WVVA, but what happens if we get a straightaway? What happens 2 or 3 days, it goes through the cycle and there's no real pattern. If you caught the peak formation and you're holding for a swing trade, there's a potential for a lot more profit. Okay? And also how many people have gotten in and out of trades 15-minute. You could have got your 50 or even 60, 70, but man, you got out after that first pullback because you're sitting there watching it. Swing trading, you have to develop that patience to just look for your few setups that occur all the time and just be confident. And that's, that's going to take homework, but still. More freedom, much more freedom than the 15-minute because you can look, you can analyze, figure out what you want to look for, draw your boxes, and then go, all right, well, you know what? That should take about a day. It's probably going to take a day. I'll come back tomorrow. I'm telling you, it's liberating. It's awesome. Now, in comparison to the carry trades or the rest of them, quicker profit booking, which, it allows you to utilize the power of leverage because, more equity equals more potential. If a carry trade, if you think it's going to go 1,000 pips, how many pips is it going to move before it swings back the other way 200, before then dropping another 300? There's a lot more whipsaw in your carry trades. You can see here I have less swap, less whipsaw. Okay? When you're holding trades over the course of a day, or 2 days, etc., every time the day goes over, you have to pay. You may have to pay a swap. Okay? And the swap is the difference in the interest rates. I'm not going to get too into it. That's stuff you need to explore on your own, but the same pair could have a positive swap if you're long and a negative swap if you're short on that pair. It's all based on the interest rates. But in comparison to a carry trade, you're holding for 2 to 3 days, you got to pay swap for 2 to 3 days as opposed to holding it for 3 weeks. And that could be 3 weeks of chop while you're waiting for it to go down to that magical 1,000 pip point that you think it's going to go to. Okay? Much less whipsaw. I'm going to show you very clearly there are certain large pip segments that the market moves on the H4, H1, okay? And you're going to be able to utilize that with those hard technical and price point targets I talked about on the previous slide. So there's much less whipsaw. So psychologically and equity-wise, it's not as taxing. You're not tying up your equity and causing you to miss out on other stuff because, well, I already have this trade going on the carry. I've been in it 2 weeks. I can't utilize stuff. I can't utilize my equity in other trades because I'm focused on this for the past 2 months. So the swing trade, wins. The only cons are strictly against the M15 because there's more potential for break-even trades. What's one of the things that's common about what we think might be a peak formation? Well, reset. Okay, I'm going to show you how not to give all your profit back on those. I'm going to show you how to handle those. But there is more potential for the break-even trades and giving profit back as well as wasted time because, you get emotionally invested in them. You have to not, that's the goal, is not being emotionally invested in it. And that requires, money management, taking smaller risk. It requires a lot more patience than the M15, obviously. More of the patience, because you have to wait for the M15 stuff. You have to wait just as much for swing trade setups. You have to wait for specific setups, but it requires more patience in just leaving the trade alone. Let it produce. Oh, I'm sorry, excuse me. Of course, it ties up your equity a bit more than the M15, but I think that's balanced out by the big moves. I'm very sorry. And occasionally you can have deeper stops depending on your entry, but we're going to talk about that. The carry trade, there's two pros, much bigger moves and even more time away from the keyboard, but look at all the cons. Every con on the swing trade is just amplified with the carry trade, okay? Requires a ton more patience. You're tying up your equity. Stuff is moving down. You think it's going to go down 600, 700 pips, and it hits some wall and holds for 3 weeks. You got your equity tied up for 3 weeks. You're paying out swap left and right. It's way more psychologically taxing because you're watching all this other stuff go by that you could be in, but you got all your equity tied up. And how often do you really go, oh, well, you know, hey, maybe I'll cut half the position so I can free up some of my equity. People can't do that on the 15-minute trades when they see a second setup going on. They can't reduce some of their positions so they can get into the other one. All of a sudden, you're going to do it with 10 left in a carry trade. So as far as I'm concerned, the choice is clear. Just focus on swings and leave the carries to the funds, please. All right? All right, so just quick recap. What is our focus? We are swinging. We are not carrying. 2 to 3 days, up to 5. I would say start with 2 to 3 right now, and as you improve and your equity grows, that's when you can start, you know, holding more. As you're doing more homework, you start making some bank. You start seeing like, oh, you know what? At these certain points, I realize it can go 500 pips. I'm going to hold it for that. But for now, I'm just going to grab 250, 200. Okay? Booking profit and increasing our position size. That's why we want 2 to 3 days and hard targets. Instead of holding for 500 pips, why, you know, and suffering through a 200 pip pullback or 150 pip pullback, why not book profit on 200 pips, wait for that inevitable 50 pip pullback to the blueberry or the mayonnaise, and then get in with, you know, an increased position size because your equity has increased. And our other focus is on freedom. You got to remember that. Our freedom, our leverage, our time, and our money to gain freedom. Okay, so what are we looking for? The criteria and the conditions, okay? We're going to talk about the charts, what we're going to be looking at, the indicators, the price, the setups, etc. So everybody who's been falling asleep because I can't shut up about the basics and the fundamentals, now you can start to pay attention, right? Okay. Time frames, primarily H4, okay? This is going to be our roadmap to our, and it's going to be all-encompassing on the bigger picture, all right? Steve always said H4, H1 is your roadmap, 15-minute is your entry. And then scale back up and manage on the H1. Okay, it's been expanded now down to 5-minute, 1 minute. There's all sorts of different techniques, but Steve realized, you know, there's just too many different flavors of people. They want different things. There's different personalities. He even said, you know, he doesn't swing trade because it's just not him. I was so happy when he said that. I don't know, it might have been 3-4 months ago, doing one of the charter schools or something. You know, he said, people always ask him, Steve, you know all this about the market. Why aren't you holding for 3 days? Why are you just taking your 50? He said, it's just what I like. It's my thing. It's my personality. You know, trader, know thyself, right? So maybe if you've been having a lot of trouble on your 15-minute and you're trying to scale down to the M5 and the M1, if that's not working, you're still struggling, give the higher time frames a shot. It seems counterintuitive. Almost. Well, if I can't handle the M15, how am I going to handle the patience to do the higher time frames? Well, you'd be surprised. Okay? So we're going to be primarily looking at our H4. Then to our H1, the zoomed roadmap, which includes the market maker cycle, right? MM cycle picture. Okay, proofread your slides if you're ever going to do a presentation. I thought I did, though. Entries, yes, we are going to be entering sometimes on the H1. This is pretty exciting stuff, okay, as well as confirmation. And when I say the MM cycle, that's not MM cycle picture, I mean the benchmark, you know. This is primarily where you see it. But there are huge, bigger structures on the H4 that I want you to take advantage of, okay? Now, D1, I know a lot of people love the D1. I'm not ignoring the D1, but simply I use D1 for added confirmation and targeting. Confirmation of like, is it likely to turn around here? Is this my big structure? And targeting, where am I, you know, where my take profits going to be? I'll look to the D1 for added confirmation on a lot of this stuff for zone flips and for trapped volume from earlier, you know, that you can't see on the H4 and the H1. And you're like, oh, why did it stop here? It's a single leg. I hate single legs. You go to the D1. Oh, that's right. The first leg was put in 4 months ago. Okay? I'm not talking about support and resistance here, but there's trap volume. There's psychological points. And, we'll talk about it. Patterns. Okay. Larger structures are your friend. Okay? Larger structures. Now, we see a lot of examples of peak formations that happen over the course of a day, and they produce, but a lot of times those are the ones that will give you like 2 levels up, and then it just kind of meanders, and I get these emails, where was the 3rd level on this? Well, it's coming back down for a second leg, larger structures. So I want you to start looking at these larger structures on the 4-hour and the 1 hour, where it takes like a week, 2 weeks for the second leg to be put in. You can trade the entire portion from the first leg into the second leg, 3 levels down, 3 levels back up. That's what Steve is talking about. But it takes a concerted effort looking at this stuff on the H4 and the H1 to really see it. So these larger structures, okay, inside of them, P formations, your M's, your W's, the head and shoulders. Level 1, safeties. Both H1 and H4 have safeties. We're going to take a look at it, but when I started the swing club, there was a bit of a miscommunication, and me and Steve, had to go back and forth about a couple things. But, when he gave me his blessing on it, he left me with, some parting advice like, look, man, you guys want to look at your safety or your swing trades. Start, look. Here's my advice: start with your peak formation. Look for anchored peak formations. Level 1's been put in; it's anchored. Take your safety and trade away from it for 1 to 2 days. Well, for, approximately 2 days. Okay, so we're going to be looking at that, the P formation safeties and structure components. That's why I call them structure components. Midweek reversals. Very important in regard to what I'm going to be talking about in terms of these larger structures that we kind of get lost on and don't see spread out over 2 weeks. False move week beginnings. I got a little asterisk there. Those are circumstantial. I especially like false move week beginnings when it's the second leg of a larger structure or part of a second leg of a midweek reversal. We're going to be talking about this stuff. Now pay attention to these acronyms. I use them all over the place. And of course, structure middles, which are the apexes and the naders. I just call them middles. They can occur anywhere, but they have some particular, a lot of times the structure middle is the midweek reversal. The structure middle can also be the false move week beginning. That's an additional component, an additional combination. Like, is it a false move week beginning? Yeah. Is it a structure middle? Absolutely. Fantastic. Okay. Price action. You want to be looking for aggression. I call bursty behavior. It's nothing new. I'm not making this stuff up. It's 3 pushes into the area with threes all over the place. You want to see aggression. It could go right to it, go past it, stop dead, 25 to 50 pips below or before the first leg. But either way, you're looking for burst, hold, burst, hold, burst, hold in some fashion. I remember a couple years ago during a boot camp, Steve was showing a pattern. He was reviewing the trades from that week, and I remember seeing this trade that I got totally smoked on. It was an M formation off of a blueberry, right? And I said to him in the chat, Steve, like, why wouldn't you have taken that? Why are you looking at the next? Obviously, it went past. It didn't stop. It went past, and he said there was no speed into the area. Aha. Okay. Jim constantly talks about the speed, the inducement into it. He loves talking about that speed, and he doesn't do it because he likes the word speed or anything. It's critical. It's vital. Again, inducement, trapping, shifting, repeating. Okay. Now, the obvious trap moves. Okay, the structural. For example, the second leg past the first. That's a huge trap that I love to see on the H4, the H1. Candle patterns. I primarily look at railroad tracks, stars, a big pin ending on a hammer, and on occasion a cord of wood. You see a cord of wood on the H1, especially sometimes on the first leg. I love those. They are very endearing to me. All right, price points. The sweet spots. If you don't know what the sweet spots are, it's part of the AFP price line grid. They're very valuable. Like, we can't, I can't thank Jim enough for getting that developed. Okay, it's kind of in vogue to be like, oh, I don't care what the price is, just show me a pattern. I've heard that from pretty much every person that talks about any sort of method or any technical trading, but the fact is prices play a very important part. And, I'll talk about that in a bit, but also these things called quarter points, which I'll get to, okay? But they are similar to the price points with the sweet spots. It's just they emphasize different prices, and like I said, we'll cover it. Price action trap volume, what's to the left, okay? TV and 2TL, what's to the left? I put that on my charts all the time, 2TL, to the left, and trapped volume. These are vitally important for knowing where it could potentially reverse and where to get the hell out when you're in a trade, okay? Technicals, this is all fairly, 5200, 800, some 13 with the added confirmation, the blue tracer, price line grid. It might seem like I'm just listing off everything we already use, but, I'm not, using the work time. And I use some things slightly differently, but not entirely. Okay, the ZUP, the harmonics, those can be very fantastic in context. I have a couple specific things that I look for with the harmonics, and we'll talk about that. TDI is very important. Steve has always talked about this, and I've only just recently started rewatching a lot of the older videos, and I can't believe how much stuff I missed. I always talk about how I've been to 9 of his live seminars. I think I've watched all of his videos, the main course at least a dozen times, boot camps probably 5 or 6 times each, ridiculous amount. And all of that was before I ever did the homework. After I started doing homework, it's hilarious. I never went back and watched this stuff. I just recently started going back and watching all that stuff. So much stuff that he says that just I thought I knew completely went right over my head. I'm just like, yep, yeah, oh, absolutely, I understand that now. Yeah, wow, never realized he said that. So one of those things is the extreme on the H4 is gold. Extreme RSI on the TDI, you start getting divergence. It's hitting those overbought, oversold areas. That starts to indicate that you're in level 3 on the H1. It's vitally important. Okay, extreme and shark fin on the H1. This is also important, especially for signals. When you have oversold, overbought on the H4, you go down on the H1. You're also on oversold, overbought. You start looking for shark fins. You look back up to the price action. Are we at these areas that Doug's going to be talking about? Cool. I'm gold. Also on the TDI that I use, a thing I call the baseline bounce. It's nothing revolutionary. It's just I see it all the time. It's part of my chopstick divergence thing, and they are crucial. They're awesome. When certain things line up with the baseline bounce, it's almost like, dude, don't even worry about it. Just get in. All right. Baseline divergence. I'm not really going to be talking about that tonight, but when you have baseline divergence with the water on the H1 and the H4, oh my goodness, just wait a couple days and see what happens. And then, send me a thank you, Aston Martin. Okay, so the quarter points. Don't get excited, don't get worried. It is a new indicator, but it's so very basic. There's nothing to worry about. And if I go and I look at these questions and I see anybody asking whether or not you're going to get the indicator, I'm going to find a way to pull you through the computer and smack you, because we've never had an indicator that you guys are not allowed to have. Okay, so I don't want to hear anything about that. You're going to get it, I promise you. I wouldn't do that to any of you, all right? Okay, so they're pure fun. That's what they are, because they're almost like a crystal ball. It's amazing when we get to the examples you're going to see. And you're going to love me, and you're going to send me emails, and I'm going to ignore them. No, I'm just kidding. All right, quarter points. The short story is they are price point lines, but they're based on a book called The Quarter Point Theory. I'm going to stop there and tell you there's no need to go get the book. It's kind of like how Steve talks about with his market maker cycle. People come back to him, oh, like Elliott Wave, so it's just Elliott Wave. No. Can you throw a market maker cycle into some version of Elliott Wave and go, oh, look, see, it fits? Sure. Just like you can throw Fibonacci's onto certain things and say, oh, look, Steve's using fibs. That's not what it is. Does it line up once in a while? Sure. Just like we're talking with the ZRT and different things, Steve finally went like, look, okay, you know what? The ABC works in this context, in the safety trade, 61.8. Is stuff going to line up? Yes, but that doesn't mean that the Beat the Market Maker method is any of those things. And the only people that even remotely think that are the ones that understand it superficially and they haven't internalized that stuff. So you don't need to get the book. Okay, I read the first couple chapters. He starts going off the wall. There's all these different phases. It starts getting into different level waves and stuff like. You don't need that because I'm going to show you how to use it simply in the context of the market maker method. Okay, so still, what is it, Doug? Christ. Okay, a simple division of 1,000 pips. The way it's based off, what it's based off of is looking at the market in 1,000 pip increments. Okay, 1,000 pips being 1 point, and then you break that up into 4 segments. You quarter it. Okay, so you get 4 segments of 250 pips. So 250 pips is a quarter point. Okay, that's what it is. A quarter point is just a 250 pip block on the chart. Okay, now let's take a look at an example. Here's a chart. That's the grid. What you see here, right? 250 pips, 250 pips, 250 pips. I blocked out the 1,000 pip chunk, the 1,000 pip range. Here's another one. So from 20 to 30, we got our quarter points. All right. Each chunk here, you can see it's broken up into 4. 1, 2, 3, 4. And then you start the next major move here, the next 1,000 pips. 1, 2, 3, 4. If we look at we'll take a look at the next slide. Your midpoint, okay, really? Do we want to go to the next slide there, PowerPoint? I don't know. Okay, there we go. Your mid halfway through is your 500s. If you're starting at 0, you're ending at 0, your mid is your 500 point. It's all basically, it's decimal, okay? So your midway, I think in the book they call it a major half point. It's just a quarter point to me, okay? But I just want you to see and visualize the 1,000 pips broken up into 2 equal 500 pip segments. And then our next slide, our final slide is I'm just showing you each 250 pip range blocked out, okay? Now, why bother with this stuff? Okay, we have our price line grid. Why even bother with this? Well, price and ranges are just really important in the wider landscape of the market. Think about fundamentals, pundits, forecasts, market watches, all that kind of stuff. It is, especially in Forex, we're trading money. We're making money by trading money. It's all numbers. There's not even a name to get. It's not even like, oh, we're trading, May wheat or anything. What's the price of May wheat? It's no, what's the price of this dollar? So it's all vitally important. And think about why the market makers move in 3, right? What did we cover in the quiz? Movement in price creates a sentiment. All right, it induces. That's when you see price going up, it triggers something inside of you, right? It brings out the menage, the I'm missing it people. Oh my God, I'm missing it. If we can look at a cycle and see 3 moves and visually we go, oh my God, 3 moves, I have to get in. Look, it's just constantly going up. Well, when we look at the price movement, that it's went up from 110 to 112.50. Man, it's moved up 250 pips. It's moved up 300 pips. I'm missing it. I'm missing all this. Okay, it's part of the whole psychological gamut that they run on us. We have the psych levels, the price line with the round numbers in the 50s, moving averages, crossovers, stuff like that. When price goes above a moving average, X amount of pips past. It went 30 pips past here. I'm in. They're all execution triggers to that monkey that Jim talks about all the time. They all present psychological breakpoints, okay? So there's something about a 250 to 500 pip range. It beckons to us traders. It creates that sentiment. It says, you are missing out, okay? Now, this is the stuff that doesn't really get discussed in the book, okay? This is why this is Btmm style swing and why I'm using this thing, this external thing in here, okay? 250 pips also provides enough of a breakout past a large range, okay? This is going to one of the phases of the market, the cycles of the market, which we'll be talking about, but a 250 pip range will give enough of a movement past a range to get people all excited. And there was one of them this week that I want to show you. It was fantastic, okay? And also enough to provide a profitable range, 250 pips. You guys have seen, pound dollar in the past couple weeks. And, just over the past year or so, euro dollar and pound dollar have been, they got stuck in some wonderful, wonderful ranges, okay? And those ranges, you have crossovers galore. Oh my God, the triggering that's going on with the orders. You have false breakouts and narrowing of the range, which means you have TPs not being stops, which includes the pendings and the stop losses, that getting triggered both ways, left and right. And subsequently, where benchmarks are seen one after the other. Because don't forget, we're talking 4 hour here. I'm mainly focused on the 4 hour. Right? It also gives them opportunity to validate the technicals. Another thing that Steve repeated constantly is their job standing behind the screen. Think about a market maker, not in front of the screen. It's their job to create the sentiment, act against it. And how do they do this? By driving price, inducing, validating the technicals. So there's plenty of range to validate the technicals and the systems based on those technicals. Your trends, 250 pips is enough to start fanning out those MAs to create clear, visible, and sizable, channels, all the equidistant channels and all these channels that different people draw, the upward sloping and downward sloping trend lines. If it breaks here, it does this, but it blows out the Bollinger Bands and your oscillators. As the MAs start to get fanned out, it starts to create the crossover signals. Your CCI, the RSI starts moving over the baselines, the MACD. It gives you all these different strength mode kind of signals. It's crossing over the middle. We know to look for a lot of oversold, and overbought, but how many times have you seen oversold RSI up in the oversold area, and it just keeps staying in the oversold while price keeps on going up? There was a guy one time at one point, said, when it hits a certain area, it makes a new high, and it's hovering up there. I like to think of it as overstrength, not overbought. I thought that was kind of cool. So they use it to validate the technicals. Now, on the numbers, why pay attention to the price? I could just look at M or W or a BAT or this and that. We still like to think in numbers. We are in numbers. I see it all the time on my reality television show. All the time. Oh, there's a head and shoulders over here. If it breaks past 131, I'm in. Oh, look at that ascending flag. If it crosses the 50, I'm in. Oh, if it pulls back to the Z, all that kind of stuff. And how much money is in the market, flooding the market, that's based on robots and EAs, trend systems, algo traders. Okay, a lot of big funds, and most of the big funds, and even the small funds, a lot of them use computerized systems. They have systems. Are they well-researched systems? Well, it depends if they're profitable. Either way, they're using systems, and you can see a lot of the trends, a lot of the funds. They have maximum drawdowns, and their signals their systems may produce only a 60%, accuracy hit rate, but due to their money management, they wind up making out. So there's a lot of false signals and stuff that they can create by manipulating these numbers that fire these robots and trend systems from the funds and from retail traders. So that's why the numbers are important, and why I ask you not to overlook at them, okay? Because a lot of times I'll see trades that are posted, like really good trades. I'm not dogging on any of the trades, nor would I ever, but it'll say like, came out of the range and did this, and it was tea time or shadow box, and it hit the 50, or it also hit the 0-0. Well, to me, the 0-0 hitting that kind of stuff kind of gets moved more to the the middle of the line, not to the front of the line, the middle of the line. Okay, we also have to think about our market conditions. You have trends, you have chop, and of course the MM cycle. And this is all focused on the H4. I actually particularly look at 3 different phases of the market. Range bound, tighter consolidation, and an actual trend. We'll get more into that at more of a different time. But I just, excuse me, now I'm getting the hiccups. Geez. I just want you to be aware that it is vitally important. You need to know what phase the market is in, because each cycle the market behaves differently, okay? They all have the same moves within them, the whole fractal approach, but they simply handle them differently, the market makers. It's just variations on a theme, right? Now you must act accordingly and tailor your approach depending on your market conditions. If you're trying to trade the same way in a chopping market, in a large range-bound market as a trend, you're going to just constantly give everything back. If you're trying to trade range-bound style inside of a trend, you're constantly going to get smoked because it's just going to keep going down while you think, oh, I got level 3. It's going to go up 200 pips. Okay? Trends behave differently than large range bound. I pretty much just said that. And you'll start to notice that consolidation, and when I say consolidation, I mean, tighter ranges instead of range bound, which is wider ranges. Consolidation on one time frame is typically a peak reset area or level 3 on another time frame below it, and vice versa. Okay? So knowing where you are in the cycle and what time of market it is on one time frame is going to help you deciding how to trade the lower time frame. Now, I'm sure the questions may be starting to pour in if you didn't listen to me. But you're gonna see this stuff. I'm not gonna leave you hanging on the chart. Okay. So you got to ask yourself, are we in a choppy market? Which, again, this is H4, which is large and range bound. I call a choppy market large and range bound, which tends to be a D1 consolidation, a tighter D1 consolidation. Are we in a clear longer term trend? Or are we simply in H4 consolidation? Again, that means smaller area consolidation in the middle of a longer-term trend. And those small range bounds, the small consolidations on the H4 tend to be the larger range bound on the H1. An H1 peak or reset territory, where you're going to find a lot of the 2 to 3 day market maker cycles up to 5 day cycles. Now, each acts differently, and you need to know, what am I looking for in this particular phase of the market? How do I respond? Again, Steve says, what are we? We are fringe traders. We are reactive traders to the market makers. Okay, so you have to consider this stuff. You can't just go and sit at your charts and go, oh well, yeah, there's level 2. I'm looking for stop on low rise. It's a different game than 15 minute. Okay. Okay, this is just a brief slide. I just covered this. D1 consolidation will be H4 range bound. H4 consolidation will be H1 range bound, etc. All the kind of fractal stuff. Again, consolidation is the tighter areas in a trend, whereas the range bound is big, wide, 250 to 500 pip swings. So our setups, how do we use this stuff, Doug? Let's talk specifically about the quarter point, the grid builder. Sorry, I may have, that's what the indicator is called, okay, grid builder. Okay, now why is it different from the regular price line grid? The ranges are clearly defined. I just explained why the ranges, why they use these 250 pip ranges, what purpose they serve, what's the benefit. So this is what you're looking for, okay? Or this is why we're using it. The ranges are clearly defined. They're visually impactful. You get to see them. Bam. Okay, there's my quarter point. There's my range. That's what I'm looking for to hit and reject off of, or to hover and then continue. It shows you, it blocks off nice clear levels of inducement. There's no snow blindness, okay? With the other price line grid, the basic one, there tends to be some snow blindness. I pointed out some trades to people, be like, oh, look, it hit the 52. And I didn't even notice it was still on there. I've had that on there because it's got the gray, so it kind of blends in. And I understand why it was designed that way, so it's not imposing. But Jim was nice enough to alter it a bit for me because I wanted to get rid of the 25s and throw and add some color to the other stuff. So while my price line grid doesn't cause any snow blindness, there's still 50 double zero, 50 double zero, 50. It's all over the place. So you can at times tend to kind of lose sight of the 4x for the trees, as it were. So it kind of eliminates that. And after I show you what I show you, it's clearly they have significance. So why not pay attention to them? They're pretty much added confirmation. They're just like, wow, if all this stuff is happening at a quarter point, let me jump in. Okay, but precisely how do we use them? Here's the meat, right? You want to look for 3 to 5 days or clear bursts of movement into them. Okay, this can also include. It doesn't have to be 3 to 5 days. It can be a zone flip. That's a different animal. But in general, when we're looking for those larger structures, for the peaks, the head and shoulders, that kind of stuff, we want inducement into them. So we don't want 3 to 5 days, or 2.5 to 5 days, I should have put that, of clear inducement into it, all right? Patterns and structure segments at them. What did I say the patterns, excuse me, hold on one second. What did I say the structure segments were? The middle, the second legs, okay? False move, weak beginning. It's not part of the actual, it's not like a physical section of the cycle, but it's part of the structure, all right? Traps at them, right at them, or 25 to 75 pips above or below, which are incredibly awesome. I'm going to show you these, okay? Confluences at these areas. So you want the movement up into the price at a quarter point, a moving average crossing over the quarter point. When price smacks into a quarter point with the moving average crossing over, just get ready. With a baseline bounce, a shark fin, okay? This is what you want to look for. Print this out. Screenshot it if you haven't, okay? Next. Sorry, I wanted to cover this because I know some people might be looking at this and go, all right, dude, now I'll just let you read it. Okay, so that is precisely what I'm telling you. 25 to 75 pips above the quarter point is a great inducement area. Does anyone notice 25 to 75 pips? How many pips is that? Could that be 50? Does Steve actually said when they hit the next level, if they extend the level by a stop level, they usually do it to 25 to 50 pips? I wonder if there's something to these quarter point things. Okay? Now, I'm going to simplify for you, though, because this is, I say 25 to 75 pips, but I barely even kind of really look at it like that. You want to know what I do? I look at the 50 pip, the sweet spot, immediately above and immediately below the quarter points, okay? We're going to see it. We're going to look at it. It's that simple, okay? Like, that's really it. Because they may spike up. I don't really care if the pin hit the 75-point line or even the 100-pip line above a quarter point. I want to know how it handled that 50, that sweet spot above or below. Because oftentimes it'll spike up. It'll spike to the 75 pips above, and then it'll close right below that sweet spot. Or it just keeps working that sweet spot, that 50 pips above the quarter point or 50 pips below. So it's very important. All right? So setup specific, we want the larger structures, all the patterns you already know, structure segments at specific AOIs. And AOIs, I'm sorry, that's my own, I just use that. I'm very acronym initialism heavy, so I apologize. That, I just mean an area of interest, okay? I call everything AOIs, area of interest. Quarter points, 50 pips above or below, large moving averages, either a breach or a pin, okay? Don't get upset if it breaches and closes above, the 200. If, the 200 was crossing the quarter point, it closed above the quarter point and the blueberry, but wow, it starts throwing a head and shoulders at 50 pips above and then shifts back below the blueberry. It's game on, okay? And we're going to get to it. To the left, trap volume, flip zones, and of course TDI overextended. There's boom, okay? Here's your checklist. Most importantly is, that's right, sorry, confluences, okay? Multiple criteria for multiple pips. Remember that. Multiple criteria for multiple pips. Turn it into a song if you need to. We're not just taking M's, W's, and heads and shoulders, okay? Context is needed in all these setups. Now here's your list, okay? Print it out. Everybody loves the checklists. Okay, here's things to consider. I don't mean print this out or write it down and then have a little spreadsheet with a checklist and all that. I don't mean that. These are things that you need to internalize from doing the homework. I don't have a spreadsheet next to me with checking off a bunch of stuff. You want to get it to the point where you can walk up to a chart, just like Steve says, walk up to the chart, be like, oh, we're in this level, it's approaching over here, 3 days up, 250, we're heading into the next quarter point, moving average is crossing over, they did moving average tug, which is a thing I'll talk about, but they blah, 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 you run down the list and you just know it, and you're like, okay, it's hitting off of here, I expect in 2 to 3 days it's going to come back, give me a second leg and move back down here, I can wait for 2 days for 250 pip move. That's what you need to be able to do, all right? So, let's go to the charts. What did this week alone have to offer, okay? I'm kidding. I had to. All right, so we're going to take a look just at here, okay? I'm going to go to the euro. I'm sorry. I'm just noticing it's 8 o'clock already. I'm going to get through these really quickly. I'm sorry. Does everybody want me to put this off till next week and just take questions? Or let me see. Let me take a look at the questions. No, keep going. Keep going. Everyone's cool. Okay. All right. You don't have to yell. You don't have to yell. Okay. Yeah, it's not so much about my time. I could talk about this for hours. It's just that, Joe's here, people recording. I just don't want to take up too much of their time. Okay, so here I have, this is the 4 hour. We're focusing on the 4 hour, okay? Actually, so this is study sources. I'm just going to escape out of there. My screen went for a second. Don't anybody freak out. All right, so I'll bring back up the platform. I'll give it like 10, 15 seconds, let my screen catch up. Does everybody see on my platform? Yes, okay, cool. All right, so we're going to start with the euro. Now there hasn't been too much this week because what I have been talking about, your major things is your quarter points. These are your quarter points. Before, what was I showing you? Before you were seeing this, it was just a blank chart. I was just showing you the quarter points on the H4 and the D1, okay? Now you can see it in a live chart, okay? There wasn't a whole lot going on here this week, but, what I did see, okay, is a lot of people were expecting this to go down, but we basically had a reset off this 1250 quarter point, okay? We had our peak down over here, and I'm going to try not to, because I can go back and start drawing everything on here and go see, but I got a bit of flack. I posted a chart where I placed it pending up here. And the reason I did it was because after studying these higher time frames, I see 1, 2, 3 coming off of here. To me, this entire thing right here is the peak formation. We got 1, 2, 3 bursts up on the 4 hour. And what did I say about 50 pips below? Let's look at this quarter point. What's that quarter point? 115. What's 50 pips below? 114. 114.50. I actually pretty much nailed it. Okay. I was looking at how they were handling all this. They came up burst, and kind of just started trickling. They were hitting this. They were hitting this. They were hitting this. What did I do? I put a couple pendings up here. Bam. Now, did I take it short all the way down to here? No, because I don't trust it. The market, the trend is starting to move up. Steve just had a wonderful discussion about this, about how I think it was like 80% of profitable trades. I don't want to get it incorrect there, but there was a higher percentage of the more profitable trades occur in the trending market. So on the 4 hour, the mayonnaise, the blueberry, the mayonnaise is over the blueberry, 50's over the mayonnaise. I'm not worried about taking this too far down. It's not a range-bound market anymore. Over here, it was range-bound because we had pinched moving average. We had this nonsense, okay? What did I talk about before? The range-bound market, moving average crossovers, all sorts of things are getting triggered. Things are starting to spread out now, so I only wanted to take it down to the bottom of the structure, and that's where I did it. I pretty much got out right around here, okay? We're going to talk more about management. We're going to cover management, where to get out, how to lock in your profit, how to maximize this stuff next week. I hope you guys are excited about it because it's really cool stuff, all right? But also, let's take a look at this now. Man, I have to move this. There we go. Okay, 112.50, all right? 50 pips below. 112.50, we want 1,200, okay? And you're going to get really good at calculating these, all right? What do they do? 25, and this is why I say 25 to 75 pips below, okay? You're looking at about 25 pips to 75 pips here. It doesn't have to hit that sweet spot. I prefer to look at the sweet spot. Let me just get rid of those, and I'll go down to the H1 just so you can see, all right? You can see the sweet spots on the chart. I have them, okay? We were just looking at this area over here. That's where I hit the pending. There's your sweet spot. Now, they hit this blueberry. They extend the second leg past there. Okay, they get it. You get a reset up. It just continues up. Man, if they didn't, they just gapped a little bit, but they stopped. They stayed off of that. Okay, so these are the kind of things I'm looking for. Did I take this long? No, it's not my bag. There was never any real clear inducement. There was no baseline bounces. The stuff I'm going to be talking about. Okay, but if you notice, where do they come in. Anybody who got screwed over here, anybody who started going short, that's a nice 4-hour hammer, okay? Anybody that took it on the break of this, anybody, who had a long pending, boom, they're out. Oh, you don't think? You're out, okay? They moved their stop to break even. You're out, all right? There wasn't a lot this week specifically with euro, so that's why I'm going to go to pounds. Now, this is really cool. I was really excited about this. What did I say about the range-bound markets, okay? Look at how they handle this, okay? They give us our peak, all right? And then we start to get into the range-bound market. And they do this, look at this. Nearly 3 months, or 2 months, I'm sorry. We got 1 week, 2 week, 3 week, 4 week, 1 week, 2 week, 3 week, and then here was a half week, so 3.5 weeks. So nearly 2 months of chop. And what did I say about the ranges? 250 to 500 pip ranges. They start to create the range, they widen the range. Then they pull the range in, and then what else did I say? 250 pips is extremely valuable for what? For creating the break of a range to induce the trend, the long-term trend traders and breakout traders to go long. Okay, so I know the answers are already over here, but what else do we have? What do we have? Okay, we break here, we start the range, bam, pull back, widen the range. Notice that they're starting here, they're starting their behavior, they widen the range. Okay, they extend it, smack dab up to the quarter point, back down into this area, trapped volume. Okay, now, what if I put this here, horizontal properties 1.40 the quarter point. We want 50 above there, 150. Well, gee, right down to the sweet spot that's above the quarter point. Go up here, induce past here, trap. They even continued a little bit past the quarter point, dropped back down. Shift over, get a bunch of orders to trigger, stop dead. I'm going to zoom in a little bit here. Notice they stopped a little bit short of that. They don't want to trade. They don't want to release that volume just yet. They have goals. Okay, shift away, shift up, keep off of here. I wonder if we're going to see anything right here. We got 45 on the quarter point. 45 minus 50, 144.50. Wow, I'm getting pretty close with hitting. But then again, I don't even need to really guess because they come up 50 pips within there. Look at that. I'm not making this stuff up. And then they finally come down, again, crossover. What do they do now? Now they're going to break. What do? Stop dead right at that quarter point, 250 to 500 pip range. They're creating a 500 pip range here. Then, again, when I said they widen the range, they create the false breakouts. They pick up the pendings all the time. People are getting stopped out left and right. Then they start to bring it in. Then they slowly rise. What was the other benefit of the 250 pip range? It gives plenty of opportunity for the technicals to start fanning out or to start validating, for the trend indicators such as the moving average to start fanning out, the market baseline to start signaling up, and 250 pip range is a deep enough range for them to break a wide choppy range and get people excited it's going long. Everything's right here. That just it's all over the place. That's why I was really pumped about finally getting the chance to show you guys this stuff, because if you can look at this stuff and see this wide range and realize you're in a ranging market and go, oh, okay, I'm looking for this stuff. I'm looking for sweet spots near the quarter point. I'm looking for how they're going to handle the quarter point. Okay, and then stuff starts to break out. And I want to bring something up. I was just talking to somebody last night, and they were asking me specifically about this. I'm going to go down to the H1. And for the person that I was talking to, I am going to show a screenshot. I blocked out your name, okay? Nobody knows who you are. I am not even using pronouns, okay? I hope for the... Oops. Oh, I put a little bit there. I'd like you all to take a look at, this snippet of a conversation that I had last night. This person asked me, what level is GU in? Seems like level 3 to me, but also the bearish Gartley has been fired for over a week now. Please read my response. And of course, I had to ask, by the way, did I get the homework from you? Because you might know this. I if they didn't know, okay? They asked me this last night when it was right around here, okay? And what did I say? I'm expecting it to go to the 4750 or at least the 4700. And to me, this was level 2, okay? I'm not even going to get into the levels right now. And what happened? Why did I expect it to go any further? We have a garlic, Doug. There's these M formations. Isn't it supposed to go down? Answer number 5, question 1, or quiz 1. Market is not supposed to do a damn thing, okay? What I see here is price has broken this quarter point past 50. The reason I look for the 50 above or the 50 below is because generally when it goes up to 100 and it doesn't get the hell out of there, it's going to the next quarter point, or at least to the next sweet spot that's below the next quarter point. So this person asked me this stuff right here, okay? And there's no aggression really going into it. I expected it to hit the 47.50. Oh my goodness, okay? So I'm not showing this to impress you. And what's that old phrase? I'm not showing this to impress you, but rather to impress upon you. I want you to see this stuff for what it is, okay? And the meaning behind it, what's going on, okay? Now this is another pattern that I like. I call it, I don't know if I had it in there, but 2LH, okay? Second leg harmonic. Is this a second leg? No, but if the trap move, 2LH. If the trap move outside the range of the harmonic, I find these particularly useful in this 4-hour, 1-hour swing trade extravaganza. When you see this range, because this range doesn't just mean, oh hey, look at this box and then that's it. Okay, this range is based off of specific Fibonacci numbers that I don't know which ones it uses and how it calculates what the deep spot, the depth of the box is, nor do I care. I just know that a lot of times I see you'll get a decent pattern in here. There is some stuff that you could have taken in here for the 50 pips down back to the water. I'm not arguing against that. We're talking about swing though, okay? So there was nothing particular that I like seeing in here for a swing trade because it had already extended past this 50 and actually trapped back below into the 45. I've done enough homework to know that's going to the next quarter point. Plus, they just broke out of this big range, and I covered. They used 250 pips specifically. Now, they might flip the zone and continue going. I don't know. Don't care at this point. This is what I was expecting. All right, now we're going to take a look at the dollar Swiss. This is great. Just in the past couple weeks, hitting off this 95, we see a smaller structure on the H1, rise up, come back down, flip this zone, head back up. We see 3 bursts. What do they come down? Larger structure. Okay, I'm going to try and take a guess again. 95 minus 50, 94.50. Can we hit that again? Really, Doug? Okay, so we got our second leg. This is the aggression. Do you see the burst, burst, burst? Aggression. That's what we're looking for. Okay, when you take this kind of stuff, you can be pretty sure that you're going to get a successful kind of peak. All right, you could have taken all this and great up to the next quarter point. Isn't that the next quarter point? Hit this into this area, and I'm kind of curious. 97.50 plus 50 is 98. What do we get? Oh, they stayed right off there. 25 to 75 pips. I call it the 50 line. I say just pay attention to the 50, but that's what they'll do. They'll induce technically a 300 pip run. But do you see what I'm talking about? Do you see how the quarter points outline these chunks of legitimate price that it psychologically must induce humans to pull the trigger? There's something about that 250 to 500 pips within there, and it breaks it up nice and even because we work off of these even numbers, all right? Now, I'm not even going to look at the dollar yen. There wasn't much there. Aussie dollar. Let's take a look at this. I'll go down, I'll go down to the 1 hour. What do we see? 3 hits the high. This is this is above that sweet spot, but this is why I say 25 to 75 pips so you realize. Let's take a look. What's the measurement from there? Oh my goodness, nearly to the pip, okay? And then they break 3 hits to the high, shift down. You could have taken it right here and gone to bed, and you're fine because they're breaking it. Everything's fanned out. What do we have? We have marked baseline bounces down here. I talk about them. I'm just trying to get through this really quickly so I can get to questions and Joe can get on with his life and everybody can do things. But we are going to cover all this stuff much more in depth next week. I'm just running through this week to show you alone. Well, there wasn't this much, okay? I know I'm looking back here, but I was leading up to how over here they came back to flip the zone right at the 50, the sweet spot, right below that quarter point. Was there anything you could have done over here? No, because you'd be stupid to do so because it's a major, major news trade. I don't care that it paid out and that they do use the news to complete the pattern, but when you start doing the homework and you start to see that we have these larger structures that can occur, and maybe you see this, I was honestly expecting that they could have done a little south hunt back here and went up and given me a larger structure. You're going to see this all the time. Market maker cycle, two benchmark cycles within a larger structure. So there wasn't that much on here, but let's take a look at I'm just looking at the majors too, by the way. New Zealand, 4 hour. Nice big multi-week section, larger structure. I cannot say enough about them, okay? Larger structure. When we look down at the H1, what do we see? 50 pips above. We see that sweet spot right above that quarter point. 50 pips, okay? This is why I tell you to focus on them. Of course, they shifted down, and there wasn't much you could do unless you, even if you did, if you got in, you held, if you have a swing trader stomach and you knew you were right, but that deep of a news movement, you're going to want to do a retrace pending. We're going to talk about pendings next week, okay? So finally, the baller move of the week. I know I grabbed this. I know Avis grabbed this. Avis, if you're listening, I'm really proud of you. That's awesome, okay? That's fantastic. I'm so happy to hear that you grabbed this. I was even thinking about that. I'm like, I know Avis watches the CAD. I really hope she's paying attention here. So let's take the U.S. CAD on the 4 hour. You can just see all the different areas where it spiked. This is, I know this already. This is 50 pips below. It spiked it, closed above, 50 pips above, larger structure, okay? What do we see? Small, I won't cover that right there. Okay, 3 levels down, 3 pushes. Can I get a 22 trade? Okay, on the H1. This spiked well down into the middle, but what did it do? It closed back above the 50. That 50 sweet spot that's right there. We're going to go now. I'll go down to the 1 hour real quick just to show you. Oh, I had put my auto scroll on. Right to the 50, right to the 50, close back above the 50. And when I say 50, if people are getting confused, I mean the 50 sweet spot below, okay? This literally is a 50, but sometimes the sweet spot above the quarter point is a 00. So I'm sorry if that was confusing to anybody. But what do they do? Star pattern. I said that's one of the traps. And then you're good. Good for a swing trade. And I'm going to show you where to scale out and how to scale out. Because you might look at this and go, oh, well, it didn't go up to the next quarter point. Well, it doesn't have to. That's why we're going to be scaling out and managing the trade. This week, beautiful. We came off of a reset, okay? Level 1 down. Looks like it's going to be possibly a peak if you're not paying attention. It had the potential to, obviously, but it just rolled over. Went into extended consolidation there, okay? Then we had a channel. Oops, I'm sorry. We had a channel that started producing, and this is just a personal preference of mine. I'm not saying draw channels, but we get these runaway levels, okay? We get these runaway levels. This is how I like to draw them, okay? Now, we get this level over here. I forgot to do this. All right, let me just put level 1, level 2. Oh, something screwed up there. There we go. Okay, and then we got the level 3 down here. All right. Now, at first look, this wasn't a bad trade. Oops. Okay. At first look, this wasn't a bad trade. It was bouncing off the quarter point. It looks like it's bouncing off the quarter point, okay? But what are we missing here? And we're ending here, and then I'll take a couple questions, okay? What exactly are we missing here? No, I'm sorry. Hold on there. There's a bug. Here. I'll get rid of draw this. I can't see the answers right now, but we're missing that final aggression. We're seeing some pins, we're seeing some pins, we're seeing some pins, and frankly, if we go to the H4, the TDI is kind of crap right now. You know, there's no shark fin, there's no nothing. All right? That doesn't necessarily mean that it's going to be a bad trade, obviously, but going down to H1, we're still seeing crap at this point in the market. There we go. That's what I was looking for. If we block that out, I'm still seeing not too much going on over here. Even when we come down and start bouncing up, we're not really, it's not an aggressive move, and it immediately closes below the 13. Let me zoom in one more time. Immediately closes below the 13. Then what do we get? We get an aggressive move, hold for one candle, star pattern, harmonic fives, just misses 50 pips below and closes back above the 13, above the quarter point. You're in, you're golden, and you're sailing the yacht with me and Avis. Okay? So I'll leave it there. That was 5 out of 7. 5 out of 7 had fantastic quarter point swing trade opportunities for you this week if you just know what you're looking for. Oh, and I forgot to mention here, it gives you, boom, that shark fin. Look at this. Just real quickly before we go to the questions, 48 pips, you could have entered right here, knowing what you know now, 0 drawdown. Even though that's a 48 pip plus a couple extra for that 50, if you want to put past that 50 line, 0 drawdown, it's your gold, okay? So let me go to the questions. I know there may be a lot. I'll try and keep it brief and keep it simple. Okay. Now, does anybody have any questions? I'm not seeing, okay, I'm seeing some answers. Awesome. Avis, good to hear that. Okay, some of the, please explain the sweet spots again. That actually got answered. On the swingers version that you're looking at, just so there's no confusion, Jim was very nice enough to take off the 25 and the 75 spots for me. I am going to include that if it's cool with Jim. I will include that in the thread. You know, to look at this stuff specifically for the people that want to try swinging. You know, because I just have the 50 and the 00 line on. Violent intent, yes. How do we join the swing group? Currently, there is no swing group. In the beginning of the year, I was asked to come in and help with the CARS study group, and I said yes. And it's taken up a lot of my time, and I just kind of let the swing club took a break for about 2 weeks going into the last 2 weeks of the new year from 2015 and 2016, and it's nobody else's fault other than my own. I just never sent out the email to say, hey, everybody, let's get back together and let's start doing it again. You know, my plate became a little bit full, and yeah, so there is no swing group right now. That may change. We may, if there's interest, you know, we may start it up again. So QP goes every 250 points on each CCY. What? Quarter points are just, they're outlining, they're just lines that show you what each 250 pip chunk is. That's all it is. The quarter points are 200, 500. Quarter points are 000, 250, 500, and 750. That's it. Yeah, just always, just, you know, divide 1,000 into 4, and you get your 000s, 250, 500, and 750. To hold your trades, do you keep your MT4 open all the time or just open up every 24 hours? So I'll close down my live terminal for the most part. I usually always have a terminal open. The thing is, I'm not checking it. I'm not checking it all the time because usually where I enter is where the damage has already been done. Another one of my favorite phrases from Steve. Okay, so it is for the most part always open, but I'm not really checking it. Great, and definitely we're studying. Looking forward to next. Oh, you're very welcome, Rob. Thank you so much. Lou Prestile, what are you yelling at? I won't repeat what you yelled, but why? Oh, is that about the swing club not being around? Is that why? No, I know. Okay. Yeah, okay, so I already explained that. What is the quarter point? How do I use it to calculate my 50 above and below? Dallas, you are brand new. I wouldn't. The quarter point is the indicator. I just explained it is the 250. I know you asked that while I was explaining, so don't worry. The 50 pips above and below, that's part of the price line grid that Jim had developed for everybody. Okay, I just slightly modified the color and took out the 25 lines because I'm not down in the 5 and the 1 minute, and I don't need the 25 lines. So I just have every 50, the 50 and the 00 lines. Okay, so when I say 50 above or below, I'm just looking at the price line grid that we already have. Okay. Okay. You can get rid of the 25 by setting it at 0. Yes, you can. You can set it by 0, but you can also set it to one of the other ones. For example, my quick fix for a while, thank you, Greg, who pointed this out, was I would set the 25 to the 50. And you're basically saying set it as the 0, but I just didn't want it there. And plus, I wanted the 500 and the 00 line. If you notice on my chart, the 500 line and the 00 line are slightly different in thickness and in color than the rest of the 00s and the 50. Okay, if I didn't have that special one, this 50 would be that same thing. So I just had it slightly modified. Jim was very kind to do that for me. I do really appreciate that. And he put in the parameters that I wanted and shot me back the indicator. So that's why it looks like that. Awesome information, great session. Thank you so much, everybody. I really appreciate that. I got to tell you, I was despite all the talking I do in the study group and helping out with cars, a little bit nervous about showing all this stuff. Once you set your 50 pip stop loss, as in the most recent example, you'll just leave and let it hit the stop loss if necessary? No, that's there for protection in case news comes out. I am so selective on my swing trades that typically it doesn't come back, and if it does, it picks up my pending order to go I'll do a 50% retrace on that shift candle. Kind of how, well, not kind of, exactly like how Carr talks about with the patterns on the M15. So I wait specifically for these. If I got to wait all week for one of these, I don't care because I'm grabbing 250 pips. I'm grabbing 300 pips. I do not care. So that's why I wait for these. What did I say was the most important thing? What did I say? Most important. Anybody? Begins with a C. No, time is their strongest weapon that they have against you. Ooh, okay. Patty, good. Confluence. Everybody is nailing it. Okay, yes, confluence. So I wait for like 4 or 5 things to happen. What did I just say over here? Break of the quarter point, 25 to 75 pips. It came near that 50 pip line, that sweet spot below. Fire to harmonic, shift, candle, shark fin over the baseline, star pattern. There's like half a dozen things there. Yes, with speed, exactly, Ted. Yeah, I was watching it. I was like, because I saw that little W and I was like, no, hands off, because my monkey is still pretty strong after years of sucking it up. So I was even looking at that, and then I saw it shift down, and I was like, oh, yes, you're right, man, Ted. CAD just started going, we're going to go down here right before the shadow box. So I knew something was happening. So where do you normally scale in on multiple entries? We're going to talk about that next week. Lou, stay tuned. Okay, it seems Dallas, that is one of That is very important. That's the base. I meant chart stuff. Somebody, Dallas answered patience. Yes, that's crucially important, but yeah, I was talking about chart specific. What do you do for your risk if the stop is large? Risk, this is why I was saying earlier that I wasn't going to cover any risk management. Between the, like if you're wondering about risk, Jim has that fantastic infographic that talks about starting with like 0.5%, then moving to 1% after you have reached a certain amount. I'm going to misquote it. I don't have it memorized, but between that, what Carr talks about and Steve has constantly stressed, plus that spreadsheet, you know, I'm sorry, but I felt that there wasn't really any need for me to talk about it, but 1% is 1%. 2% is 2%. If you are risking 1% at 50 pip stop or risking 1% with a 5 pip stop, that's still 1% risk. So that's what you want. That just really focus on the percentage. If you want to cut it down, that's what I recommend you do. Cut it down. Go to 0.5% and practice this stuff in demo. Okay. Is the indicator going to be posted this week? Yes. Thanks. Now I understand QP better. Oh, you're very welcome, buddy. Joe should have warned you about me. Sorry. Oh, are you? So you're the Lou that trades without stops. That Steve is always saying Lou, and that everybody is always saying Lou. You're that. Okay, you're that guy. Yeah, I've heard about you. Yeah, you should have told me. Now I'm busting chops. So you follow the Btmm risk profiles? Yes, because I have approximately 24 blown accounts that prove that not following it is pretty foolish. Okay, so. It looks like the questions are kind of drying up. I'll leave it at that. That's like an hour and a half. I apologize to everybody, especially Joe. Does the QP lines include your Boulder 00? Well, yeah, I'm going to include, with Jim's permission, I'm going to include the modified version that he made for me, which, yes, has these colored sweet spot lines. I'm just going to touch on two more things before we go, two more slides, some recommended reading, and what I want from you guys, okay? And then we'll call it a night. Okay, cool. Jim just gave me the thumbs up. Thank you very much, Jim. Yes, I'm gonna throw that stuff in there, and well, you'll see. Okay. So. Oh, this question pane. Okay, so we have this. Okay, so what I want from you, I want you all on demo. Okay, you're gonna get. You're gonna have the indicators, the two indicators, the modified Priceline version. You're gonna have the quarter point grid, and plus I'm going to give you a template because I told you earlier I went 5 years back. I have actually 6 and 7 years on some of the pairs of harmonics on the chart. You know, we don't have a lot of opportunity to study and homework harmonics, and I'm going to give you that opportunity. So I'm going to upload a template as well as indicators. What I want from you, and I'm only giving you one template, so you will be forced to do this pair if you want to look at harmonics. I'm going to upload the GU, okay? I want 6 months of H4 levels. That's consolidation and peaks. If you're going 6 months, and I want this by next week, okay? If you're thinking 6 months, you can do 6 months of H4 levels in an hour, okay? But I want you to mark up the consolidations and the peaks. That's it. You don't need to draw level 1, level 2, none of that, okay? I just want the consolidation and the peaks. Go down to the H1 after that. On the H1, mark off all the peaks, the M's, the W's, the heads and shoulders. That's it, okay? Mark off, and you'll see they're at the quarter points, including the 50 and the minus. I want you to label all the confluences, the confluences. Well, maybe you could say it the other way. I prefer the confluences. So label all the confluences. Do you have, and mark off all the TDI stuff. So remember what the confluences are. If you don't, it's on one of the slides. You can go back and watch the video. Mark up the chart, save it as a template, and I want you to send it to Btmm Swing. I set up a new Gmail just for this presentation. I don't want the stuff with the Btmm study group email. I don't want. Mark it up, send it to me. I'll check it, and we'll go from there. But you need to understand, you need to be seeing this stuff, because next week when I start talking about management and scaling in, scaling out, all this sort of stuff, if you haven't seen this for at least 6 months on the charts and you're not at the point where you're going, holy crap, how have I not seen this before? How did I not know about this before? Hey, honey, mortgage the house. We need to start trading quarter points. I'm just kidding. Don't do that. Disclaimer. If you haven't done this homework and you haven't internalized this stuff and seen it as much as possible within a week, then a lot of the stuff that I'm talking about next week is just, it's going to be a waste, because you're just like, oh, yeah, it's just going to be online with all the other stuff you've heard. Okay, it's like, oh yeah, here's another signal, here's another this, that. Oh yeah, more entries and exits. Yeah, that's great. You got to do this, and I promise you, if you do it, it's going to change the way you see the market. All right. I just threw this out there. I want you guys to pick up. Here's some stuff. Just take a screenshot of this. I'm not going to go through and talk about each one. I'm going to talk about these another time. But they're awesome books to have. If you don't have these books, you're really missing out. Reminiscences is more of a historical fiction. Trading in the Zone is pure psychology. It's a great read. Sometimes it's a little dry, but it's infinitely better than his Disciplined Trader as far as readability. Market Wizards 1 and 2, they're a series of interviews with different hedge fund managers and just billionaire traders and centillionaire traders who have worked themselves up from like nothing. Okay, there's plenty of them worked themselves up. They gathered together, $1,000 and borrowed more from the family. There's so much good stuff in there that they're fantastic reads, and you'd be surprised how many of them say stuff that completely just goes in line with what Steve talks about. A lot of these people used to be floor traders, and they talk about things about 3 days up, 3 days down, hitting the stops, running the target areas like the previous day high, previous week low, that kind of stuff. It's amazing. The more you can reinforce this stuff, the stronger your commitment to and the stronger your internalization is going to be. All right. So indicators template, that's going to be in the forum. Just stay tuned, pay attention. I promise it'll be there. If not tonight, by tomorrow. Okay. That's it. Everybody, you have a wonderful evening. Thank you for attending. I appreciate all the kind words. Joe, I think we're good.
Okay, Doug, thanks. Everyone have a good night, and good luck trading tomorrow if you're going to be trading London. Don't forget Carr's amazing pre-market starts at 2:30 Eastern. Everyone take care. Thank you.